S&P breaks. NASDAQ is teetering on major support. The dollar rally is stalling and what that means for U.S. equities. Using the value line geometric index to determine what is going to happen in the U.S. stock market. Why good news being perceived as bad news with names like Crowd is worse than bad news being perceived as bad news as in Tesla. Is gold's recent rally sustainable? We're going to break down smart money, dumb money, and we're also going to break down the confidence spread and what exactly it's telling us and how we can profit from it. We have a huge week ahead of us with Microsoft and Google coming out with earnings and a ton of information to go through in a very short period of time. Let's get to it. Hey everybody, welcome back. Let's start with the basics. The S&P, you can see the crack right here after the gap fill. We're going to start with the daily. We're going to drill into a lot of these levels. 4,300's toast. We can see the break. What's troubling about this move is we actually had some decent news on Friday in regards to the war and what's going on in Israel, and it just did not affect the market in a way that we should think it would affect the market. The other most glaring thing to me is I tend to look at these DTLs, downward trend lines, and what I always want to see is them getting weaker, not getting stronger. These angles, they're starting to get stronger on the downside. This is not what I want to see. We're going to talk about this in pretty great detail. I really want to drill into what's going on under the hood. This is pretty glaring if you get right into it. Now, let me just click off of this one and here as well. And really what I'm doing here is I'm using these lows, opens, and closes, and I'm looking at wicks because wicks are what? Price rejection. Using this point that happened when CPI peaked. And what we're seeing is we're starting to see a crack of that CPI level. Now, why is this happening? This could be happening for a couple reasons. Are we starting to see inflation creep up again? Is that something that we're starting to see? Is that something that we have to start discussing? We can get into that, but I think it's going to be more commodities based. That's where my head is. But we have to look at this and say, okay, this is what's happening. So if that's what's happening, what are we going to do about it? And I think that's really what's important. So here we are. We can see the test. And these are important dates. Now, why are they important dates? Well, first and foremost, here was the peak of CPI. Here, this is when we had problems with the regional banks and people didn't know what to do with the regional banks. And here, what's happened up at this area? Well, we've started to run into a global conflict. So this is one of the reasons why I always tell people that they need to be aware of what's going on and how it affects the market. In other words, people will always look at the market and say, oh, it's just technicals. It's not just technicals. One of the things that I go over at nauseum and these videos, probably to the point of people are sick of hearing it, comment below if you are sick of hearing about it, is that the market in your trading needs to be like a stool. Very simply, you need to be looking at macro events, you need to be looking at fundamental events and technical events. Every time we hit this trend line, good or bad, what was it? Okay, it was a macro event every single time. And then we look at it technically and go, oh, it's done this because of this. Okay, the lines do not know that they exist. This exists because it does, because that is human behavior. That's all these bars are human behaviors. Open, close, high, low. Human behavior. When you understand that, and then you combine human behavior, which is the technical analysis aspect of it, understand that that's really what technical analysis is charting, and realizing that it's the macro events that are actually creating the human behavior. The smart people that know that inflation has peaked here, the people that know that the regional banking crisis didn't mean we were going to lose every bank, the people here that are underestimating what's happening overseas and how it could affect global commerce. Okay? All these events, that all comes back to this. It all comes back to macro, and that's what we have to focus on here for a minute, and we're going to really drill into it today. So comment below if you're sick of my stool. I am not sick of my stool, but some people might be. So let's just talk about the basics here. I use a 55, I use a 22, and a 12. Now, one of the comments was, could you please go over that more frequently so that we're aware of it? And I do read all your comments, so please comment, please share this video. This video is going to be packed, literally packed with information to help you get through next week, which is going to be very specific in defining the rest of the year, in my opinion. It's the last earnings quarter that we have coming up, and it's going to be a pretty big deal. And then after that, obviously, we have the Fed meeting, and then we have how this war shapes out. So we have a lot of things to go over here today. But most important, let's talk about what we're seeing. The 55 on the ES, and I like using S&P futures because it's continuous. That's why you don't see the SPY or SPX. This is continuous, and I like using it for that reason. Now, if we can see this, that's your 55. You have a declining 55. When I say declining, what does that mean to people? How should you take the word declining? You should take the word declining as exactly what it is. We are declining. It's that simple. Don't overthink it. It's pointing down. So not only are we under, but we're pointing down. See, here you could make the excuse for it and say, oh, well, we're just breaking and testing. All right, and that's something that you also want to pay attention to. When that happens, you probably don't want to be around half the time. But maybe you bounce like you did here, and you just don't know, or am I going to get this, or am I going to get this, right? Life's like a box of chocolates. You just never know what you're going to get. So this is what we got. Closed at the low of the day on a Friday. That should not be making you feel warm and fuzzy about anything. And when you're seeing this, we start overlaying your 200. Now, we have closed below the 200-day moving average. That's it for me. Just as so you understand how my mind works. If I close below the 200-day moving average, right there, my brakes are on. There are no swing longs at all. I can try something for like a couple days, maybe, but I am really renting things on the long side now when I start to see this. This raises my antenna. This means that the last bastion, and the way that I look at these averages is very, very simple. The 55 to me is institutional support. When I lose institutional support at all, I want to pay attention to it. When I garner institutional support, I want to pay attention to it. Then I look at the sloping of the line as well. Obviously, this is down. So not only did I lose institutional support, I'm getting less and less institutional support. If you think about the slope, am I getting more institutional support or less institutional support? Am I getting the long-term bulls or am I getting the not so long-term bulls? And is this going to flip? If I stay down here, eventually this will start to roll. It takes months, but it will happen. So we have to understand where we are in the chart. Now, if we do something as simplistic, and I would recommend doing these little simple exercises and just saying, okay, well, we've been here before, and how did that go? All right, well, that was March, and that was the regional banking crisis. This was the end of the year tax selling in here, and we couldn't get over, and that's okay. And all right, here was the clear rejection, and we were pointing down. So if we go back a year, these are your battle lines that you've seen. Now, this one's obviously very different because we ran into it, and it was very clear it was resistance. And that resistance is because you had a death cross versus a golden cross, which I think is really important. Let's get rid of that one and drop this one in for a second. And you have your golden cross right here, and back here, you were dealing with a death cross. 55 crosses 200, so then 200 becomes what? Resistance. Every time you have a death cross, that's what happens. Every time you have a golden cross, this should be support. Golden cross support. Golden cross support. Support? I don't know. Now, there's a couple cracks here that are telling me no, that's not going to be support. What are those cracks? Well, first and foremost, I'm lower here than I am here. If I come across, we can see that we've broken. We haven't broken before. If I just do the simplest of things and go, okay, well, what was the low on this? 42.35. Where are you here? You're at 42. All right, it's not exactly the low, but you're in that range. And take a look at what's going on with the RSI down here, and you can see that we're not even there yet. So that means that we could roll a lot more here very, very fast to me and get that RSI to catch up with where this RSI was previously. And that's not where I want to be at all. So that's a concern. The other concern that I have is that we're losing sectors. And before we even get into the NASDAQ or start looking at the weekly, which maybe we'll look at the weekly real quick before we go forward and look at the sectors. All right, so I peaked here, and we knew that this was a peak. We talked about this. And I actually did a whole RSI video on this. It's not even that you just lift here, it's that you undercut the 70 and then you work your way down, and now you're completely at that point where you're net neutral. Now, I'm going to tell you where you don't want to be in regards to RSI. You don't want to be below 50, and you are below 50. As a matter of fact, you got to 50 rejected, and then you made a left. When you break 50, it doesn't matter when it happens on the weekly chart. It's completely irrelevant when it happens. You break it here, that was pretty much it. You broke it here, that was pretty much it. All right, you're trying to rally over, complete rejection. You can actually set your watch to this. I don't really care if you believe in it or not. It's absolutely glaring to me. So if you look at that, once you break 50, that is it. When you hold 50, that is it. Okay? We don't know how long, but that is definitely something that we pay attention to. So if I break 50 here, I'm in for more pain. So from what I'm gathering and what I'm analyzing so far just on the futures market, I don't have anything about this that makes me feel really good. Now, I'm not going to say where we're going because no one has any clue. I would look at this and try to get an understanding of where you could go. I see a lot of people talking about, oh, this is an inverted cup. We're going to go lower. I don't know any of that. What I know is that we're breaking the 200. I can't get over 50 here. On the weekly, we're below 50. If I look at that, that enough gives me pause. If I go look at the sectors and the sectors that we're losing and how fast we're losing them, that is very concerning to me. Not only that we're losing them, but the speed in which we're losing them, especially going into this earnings season that's coming up, because this is a absolute huge earnings season. So let's click off of here and let me talk to you about what I'm getting at. So in other words, here's the RSI and look at what happened here. So we got to basically the same level that we were at before, but we didn't get to the same level. Now, what that tells you is that this is going lower. XLK, which is tech, that's telling you that this is going lower. If I can't rally higher or at least get to the same levels I was before, you don't want to be here. I mean, that's telling you that you have a problem. And what else it's telling you is that the drop may be more significant than we first thought. Because just for me to even get down here to that oversold, which we've now broken the 50 again, so you pretty much almost have to assume oversold's on the table again. That's going to take you down way, way lower. By the time that happens, you're starting to challenge the 200. And let's talk about the difference in structure that we're seeing in tech before we go any further. Here's the 55. I have a declining 55. And what I'd want to do is get rid of the 200 for a moment and just say, when was the last time that we had a declining 55 in 2023? And you have not. Now, we could have argued for a period of time that we were just going to go sideways until about October, and then it started to do this, and then we might flip and it might get better. Those dreams and hopes are now smashed, right? That's just not going to happen. So now where we have is we have to assume that we're going to crack. Well, why is this an issue? It's an issue for a couple of reasons when we start going through some of these names, which we'll do shortly. But why is that an issue? Well, if we don't have a sector that's going to lead, and here's XLC, and we need to talk about this one as well, and then we're going to get back into the NASDAQ. But I want to give this video, as much as I'm going to go over like a macro and what's going on out there, I need to give actionable ideas in this video. So comment below on how this is done. You're going to notice it's a little different. The reason I'm saying this is you're going into a big week, and this is giving you signals of the expectations of institutional traders and how they're going to handle the week. All right, now you're starting to see XLC, what's it doing? It's cracking the 55 again. I use a 12, a 22, a 55. You should use whatever you like. So if you can see here and how you're cracking lows of the day, that's not where you want to be. Again, doesn't make anybody feel warm and fuzzy unless you're short. So what does this mean? This means we've now lost every single sector to the 55 except XOP, which is gas and oil exploration. That's above the 55 XLA. Okay. Every other one we've lost. Clean that off. Every other one we've lost. And what this is also telling us is, at the end of the day, they're still selling these names. So are they going to put weakness across the board? I'm not sure on that yet. I do see some of these names that are setting out that are breaking all-time highs. And there's names that we can go through. I do like these domestic names because of the dividends. I'm not sure that it's going to matter if we see that, that big sell-off that people think might be out there. And I'm not sure that it is. But before we even go down that rabbit hole, let's start talking about the NASDAQ. And what are we seeing here? We're seeing a declining 55. When was the last time we had a declining 55? Day in 2000. How about we have it? All right, so that's, again, something we have to pay attention to. We have something going on that has not happened before. We can say that we were testing it just like we did here, and that led to a great rally, testing it here, and then you can see the test, failure, failure, failure. It's very hard to keep giving this thing a second chance, and I would not be giving it a second chance based upon some of the things that we're starting to see. My belief has been that we're going to see highs by the end of the year. I'm going to need something. We're going to need one heck of an earnings quarter this week coming in to see that. I'm not so sure we're seeing it because the breadth of the market, as I'm going to show you a little bit later, is actually getting worse on the market. It's not getting better. And that's a concern as well. But you can see how you're rolling here. And again, this is troubling me because I'm lower and the RSI is not even. It'd be one thing if the RSI picked up and was turning. It's not. It's screaming down. At the same time it's screaming down here. These are my levels. So this is already telling me that this is going to go lower. It's already telling me that this is going to go lower. Whether or not it does, who knows? But that's how I utilize it, and that's what it's telling me. And now you're seeing that decline. So we have to just look at that, and this is just the basics. I want to go over something a little bit more advanced in a second here, but they're the basics. Then you go and say, okay, well, where's the 200? All right, well, we tested the 200 here in March. Can we get here? Yeah, you can get there really, really fast. Where's major support? Well, there's major support, 13.7. before you even can get here, you have to break the 200. If you start breaking the 200, which I don't know that you're going to, but if you start rolling here and you start breaking the 200, we have to think about what this means. Well, this means that they're just going to start selling indiscriminately. Why? Most people are probably going to start locking in their year. And when we start looking at smart money and dumb money today, take that thought with you. Why are we seeing smart money all of a sudden change its tune? Because we're going to show you how they're changing their tune a little bit here. Why are they doing that? My thought process is that they're just locking in their year, and we're going to start seeing the tax selling again and everything else. When you start realizing it, you have about 10 weeks left here, guys, on the year. Maybe there's 50 trading days left. So if we look at this and we see this crack, by the way, get on the waiting list if you're trying to get into the community. I'm going to open the community up one more time this year before shutting it down again and then closing enrollment. So if you're interested, there's a wait list. The wait list will be link in description, and I'll pin the comment as well. So let's get into this. Now, we can see right here the 200. We can see the 55 declining. We can see the line coming across. All right, great, thanks. That and a bowl of soup gets us a bowl of soup. What can we do to determine what's going to happen next? Now, this is something that I utilize, and I utilize this a lot. And some people will say, well, I don't like it. That's fine. You don't have to use it. Ichimoku cloud, if I just look at the cloud, and I just get a sense of what the cloud is doing and where I am in regards to the cloud, I can guarantee that the majority of people that are, quote, traders, and I just did air quotes, their life was really very easy till about August. Once you got into this cloud, their life got really hard because they no longer knew how to trade. And you can go look at your own performance, and only you know the answer to that. And then you're trading around. And remember, during this entire time that we're trading in here, we had that whole Head and Shoulders gang that was telling us it was a Head and Shoulders. Now, if you were just trading off the Head and Shoulders, you've been waiting for this break since what, August? And you're in October and you still don't have it, right? That's why I don't predict. This is a great example of why we don't predict. We analyze the data and then we make decisions based upon the data. For example, you remember the one thing I said about the S&P? I'm below the 200. That's it. I'm done with longs. That's got to figure itself out. And that's one of my rules. Maybe it bounces Monday and I'm not done with longs. The market's dynamic. Don't be static. So if you look at how this is going and what this cloud is telling you, and this cloud is just a measurement of highs and lows from different periods of time. I'm not going to get into all of it. And then they take the cloud and they push the cloud out forward. So it's one of the only actual leading indicators out there. People will say there are no leading indicators. I would say if you were to look at this and just look at 23 and say you traded the cloud when we got above the cloud. If I bought the market when we got above the cloud and sold the market when we broke the cloud, how did you do on the year? Well, you probably outperformed 90% of the people that you're following on Twitter and YouTube, quite frankly. Probably more than that. Over the most simplistic of indexes, right? Tries to get over the cloud, completely Matumboed. For those that don't follow basketball, Matumbo is a rejection. And now you're here. And you're sitting. And what's happening to the cloud? What else is happening? We're starting to rally up, and now we're going sideways. Okay, so that's not ideal. Let's look at this cloud with the ES and just take a look at that for a second. All right, so rallying up, what's the cloud doing? Starting to come down. This cloud acts like pressure. Think of clouds like we have clouds. Think of it as actual pressure one way or another. There's buoyancy. It keeps it up or it keeps it down. Okay, just like you would apply pressure to the atmosphere one way or another, think of it that way. It makes your life a little bit easier. At least it does mine. When I can make associations like that, I go, oh, that makes sense. So here we are, sitting at the low, looking at the crack. There is nothing redeeming about that. We tried to rally, we're unable to, but this is leading you and saying, hey, for now, this is your resistance point, and this is how I view it. Doesn't mean this is how you have to view it. But I will look and say, until I get into the cloud, I have to assume that's my resistance going out to November. So this is telling me going forward that I'm going to be lower. And that's something that I take very seriously and pay attention to. It works. It works for me in trading to get a good thesis of what's going on in the market. And candidly, you'll see it right here. You get above the cloud, even though the cloud's declining, and it really didn't matter, did it? It gets above the cloud, even though the cloud's declining, and it really didn't matter. Even though you flip green here, maybe you could make a little money. But what happens when you broke under the cloud again, right? I mean, it's like Groundhog Day, guys. And what you'll see is the cloud start to change form. And it's always like this until you get those rips. You see that? I mean, this was glaring. It was just a great time to trade. Same within here from 19 on. I mean, it makes your life very, very easy way to look at the world, right? If you looked at this from like 16 to 18, you never had to concern yourself with it. Up here, you have some concerns. Now, does this mean we go sideways to down? That we don't know. And we don't know what down looks like in looking at this, but it's something we have to focus on. If you look at this on a weekly, and I want to be real clear about this, you're not below it on a weekly. But you can get to 4,000 before you're below it on a weekly. And you're not there. Whereas even here, if you got to May, it took to May to flip out of the cloud. You're not there. And I'm not saying that we're dropping that. I don't have a clue yet. I'm not as smart as some of the other people that are telling you exactly where we're going to go. So if I look at this on a weekly chart again, I'm still green. It's still wide. I could drop completely down into this and then bounce back and be just fine. So I don't know that on a longer term time frame we have a problem. What I know is on a daily time frame, right now, I have the buoyancy of these clouds acting as pressure to the downside. And that's how I view it. What else would I utilize and what else do I utilize? So on a weekly basis, I will take a look at the MACD and just say, hey, what's going on here? And I'm really interested in these crosses and how these crosses are going to go. And now you can see how we're playing out right here as well. And that's not ideal, the fact that we've made a lower low here. I look at my cross, which happened here, and I have not even broken yet. So that would lead me to believe longer term, I have more pressure to the downside. That's what that would lead me to believe. If we look at this with the ES, what is this telling me? Well, we broke here, but we've already rolled. What we don't want to do on the ES, and if you take one thing away from this, take this. You do not want to start breaking the zero line and staying below that zero line. You do not want to do that. That is the last place that we want to be. Now let's take a look at something else. Now, one of the easiest and simplest metrics for anybody to look at is stocks above their 5-day moving average, S5FD. And now, why is this important? Because this tells you the percentage of stocks that are above or below their 5-day moving average. And when you get to a certain level, there's just really nowhere to go. If you're at 100, there's really nowhere to go. If you're at 0, there's nowhere to go. Now, why am I saying this? Because when you get down to where we are, the 7 reading, you can see a bounce. And it usually can be a short-term bounce, and it can happen in a couple days. But I want to be really clear about this. If you're at something like this level, where you are right now, which is roughly around that 7. And if you do not bounce, this gets ugly fast. Now, if you go and take a look at any of these times that are under here, where you are breaking below something like that 7 or 6 in that range, and you go look at what happened to the market at these particular times, it was really, really ugly. It doesn't matter which one of these you pick. It was really ugly. If you go take a look at March 10th, if you go take a look at August 30th, any of these times in October, any of these times, you will see that this was a really ugly time. And then there's a bounce after, but that does not mean that there's not ugliness before. So if you're at the tail end of a dragon, you got to realize that you can be whipped around. Just think about it that way. But this is the easiest way for me to tell you to look at the world right now and just get an understanding, because it tells you if you're at a certain level, well, you can't go to 0. There's certain things that can't happen. You'll see this with another reading as well that I'm going to go over in a little bit here, but you can't go to 0. On the 20-day, we're not really getting any value here. We can obviously go lower on stocks above their 20-day moving average, so that's not telling us a lot. If we flip real quick and we look at the 50-day, you're in the zone, but you're not where you need to be yet. You were just here. You rallied, and now you're back down. You do not want to take out that lower low on something like this. But most important is you just want to watch what's going on with the 200-day moving average. Now, the 200-day moving average out of all of this on a percentage basis is the most important. You'll remember about a month and a half ago, I went over this where I said, hey, once you break the 50, you'll start to underperform. That's exactly what's happening here. You can see here, you can go look at the timestamps yourself. For time's sake, we're not going to do it. But in reviewing these, anybody can do this. Anybody. You don't need to be, I don't even think you have to have a subscription to TradingView, and TC2000, all these services have something similar to this. And what's important about it is it just tells you what you're doing. It's a great example to look at the breadth. Now, there is something about this one in particular that is bothersome to me. So if we take a look here, and we take a look at the S&P, and this just happened on Friday. So people will say, oh, well, why weren't you looking at this before? Your job is to analyze what could happen, associate probabilities to what can happen, and then build your trading process around that, not tell the market what it's going to do. It's very different. And if you're looking for someone to tell you what to do, this is not the channel. Right? I try to educate, inform so that you can make better informed decisions and actually learn something. Right? The last thing you want to do is be beholden to anybody in regards to your trading investment strategy. You want to learn that they're the people that make it. So if you see your line right here, hopefully you can see where I'm going with this. If we look at the ES and we look at these levels, we're not there. That's a problem for me. So if we start to look at these levels and you say like, okay, well, here's March 15th. And people will say, wow, that doesn't mean that you're going to get there or not. No, it does not mean that we're going to get here. I'm not saying that. What I'm saying is that if we were to do a very simple comparison, you can see that this can get a lot worse, a lot faster, longer term. We talked about this trend line. For time's sake, I wasn't going to get into this, but I think that it's really going to hammer the point home. Now, I was going to save this for next week, but the more I'm thinking about it, I want to get it out now. I try not to get these videos on Saturday too long because I notice there's a time frame where people will look at the timestamp of how long the video is and go, God, I'm not watching that. But here you are, value line geometric. Now, this is a weighted index by value line of about 1,700 names, and they are all equal weighted. And they basically just give you a sense, equal weighting, 1,700 names on what's going on in the world. And it is a great guide to the S&P. If you go and compare this, you'll see exactly what I'm talking about. But see these levels in here? See how you broke? Now, this is extremely distinctive. Now, above you have value line. Below you have the S&P 500. If you see where we're at now, you can see we haven't cracked and we've cracked there. What gets me, and we're going to get into the here in a bit, but what gets me about this is we made this lower low and we made this higher high as we had the one sector that was just outperforming or the one grouping of stocks that was outperforming. Maybe that's coming home to roost. I'm not saying you're getting back to this 3,800. Please understand that. This is 1,700 names. This is 500. But what I am saying is that if we do come down, there is room to come down fairly hard here. Okay, so if we do come down, there is room to come down fairly hard. What is the distinction between that statement and saying we're going to drop? The distinction is understand your risk. If we were looking at this and we were right in line with the rest of the market and the breadth was the same and we didn't have this divergence that I can't frankly find another time on the chart going back 20 years where I've seen it. If we didn't have something like this, then I might say that the drop might not be as substantial as it could be. But in this situation, I have to understand where I am and I have to utilize this data and say, this drop might be worse than we think it is. If it does drop and if it does come down, understand those distinctions. That's all the difference in the world. And watch this. Now, people will look at this gold chart on a monthly basis and say, well, why are you looking at gold on a monthly basis? It's not done yet. I get that. We have no idea what's going to happen. I can only give you the data that I have right now and go from there. Please share this video. I specifically do not run ads. I do not run ads on here. I get asked all the time, and I don't want to run ads in the middle of this, but it does boost me with the algorithm. So you sharing this video and commenting on this video, make sure that I don't have to put ads in the middle of this. So I do greatly appreciate it. I get sponsors all the time that ask, and I have no interest in that, but I don't want to really run ads. I just want to get to the meat of this. So here we are. There are a couple things going on. Number one, someone could say, well, you're forming a megaphone. Yes and no. I would go on the side and say I've got an inverted head and shoulders against a major breakout level. Someone might say this is a cup and handle. Here's your handle and the handle didn't break and this is your second chance at the handle, right? So you have the double handle off a cup and handle. That's an actual pattern. You don't see it very often. I don't care if you call it a blueberry. The bottom line that I'm going to get at here is that you are pushing. The most important thing I would take from this, and it has not closed yet, but the most important thing that I would take from this is you have Wick City up here over and over again. But see this monthly bar right here? Now we're going to zoom into this for a second. See this monthly bar right here? See how it encapsulates everything else? That is a distinctive move. And that is something that I will pay very close attention to. How this one bar right here takes in all of that. You need to pay attention to these kinds of bars. Now, whether or not we close here or not, I don't know. Let's just use the high of the bar and assume that we close here. Okay, that would mean that we have one of the all-time highest close that we've ever had on gold on a monthly basis. It would also mean that this bar encapsulated all of this, essentially, except for here. All right, and that means that you've just cleaned everybody out, is really what it means. And it doesn't mean that you're going to go higher, because here, right? You broke out, you cleared everybody out, and this is what happened here. We cleared out these people, and then we broke out. And yes, you got a little move. It doesn't always work that way, but it is very distinctive, especially when it's at the top of the chart. So if we drill into this and we understand that gold to me looks like it's breaking out, well, there's only one reason that gold really breaks out, right? There's no place else to go. And what do I mean by that? Well, where else are you going to go? You're not buying treasuries unless you're buying short term. And then we start looking at the core commodity index. Now, let's drill into this on the weekly, and I think this is pretty distinctive. But this is commodities, and this is what commodities are doing. You've been going sideways for a period of time. You're starting to turn, you're starting to make a higher high. You're holding this key level. At the same time you're holding this key level, what else are we seeing? We're seeing the breakout of that base. And you're starting to see this turn a little bit. And when we start to see commodities turn like this, we have to pay attention to it. So what are we seeing? We're seeing the energy names rally. We're seeing the gold rally, and we're seeing commodities rally. All right, what else are we seeing out there that we really have to pay attention to? Now, we talked about this about a month ago, and our point was, hey, you're sitting right in these levels. And we talked about hedge fund exposure to the dollar and how hedge fund exposure was at significant highs and how it looked like it might be getting tired. It looks to me like you're getting tired. That doesn't mean that you're not going to go higher. It just means that you look like you're getting tired. So what we have to do is we have to understand that that's what it is. And it doesn't mean that we're not going to go up, because if you look at this on a weekly, I mean, what did people think they were going to do? Get 13 weeks of straight green days? Like at some point, it's going to stop, right? So you got to a level, you're going to digest the move. Maybe you come back and bounce around. It could be good for industrials, but it does mean that they're selling the dollar. If you start taking a look at the 10 year's going to 5, I think. I mean, I don't think it's a stretch. We talked about 5.25 looks pretty realistic for you to get back here. Higher for longer is definitely the theme, and now higher for longer, before I get into the next topic, is going to basically crush the regionals. And we're starting to see that. I mean, they're going to have a real tough time here. We're starting to see that with the earnings that came out. It's not that they're going to wind up that we're going to lose more and more regionals, even though that is a possibility. What it means is that they're just not going to be very profitable. But we are already seeing rotation by what institutions are doing. And I think the biggest takeaway from this, more than anything, is understand commodities, 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 and you're starting to see a very strong interest in gold. But let's take a look at what smart money, dumb money is doing. In front of us is smart money confidence. Now, usually when we look at this as smart money, dumb money, and we don't like to refer to this as smart money. We refer to this as institutional money, because they're not always smart, but they are always money. And they are institutional, and that is how this is calculated. So this is calculated by determining what institutional traders are doing. And that's done, as we've gone over ad nauseum, that's done by what vehicles they're trading and then the size of those vehicles. I want to point a couple things out before we drill into this. This is 3 years. This is by Sediment Trader. I have no affiliation with them, but I always like to give credit when I utilize something. It's a service that I do pay for, and quite frankly, it's a pretty good service for getting just a general sense of the lay of the land. So why am I looking at this now, and what is this telling us? Well, what we'll note is that every time that we have these peaks, anytime that we have a peak, we are getting a peak over the green line, which just shows that we're getting overinvested. We tend to see a bottom in the market. Now, why is that? Why would you see a bottom in the market every time that we get invested? Well, the reason for that is because institutions have the money, we don't. I refer to myself as retail because I'm not trading billions of dollars. So you're going to see these levels here, and you can see how they're marked off really clear. Now, the next thing that you're going to note is what happens when we're at the lower point where we're completely underinvested. Well, if we're completely underinvested, what are they doing? They're getting these peaks. So underinvestment, and we're getting a peak in the market. And I think that's an important distinction. No matter where that is, the value could be relative, and I'm breaking this down for a reason that way, but you're getting these valleys, and when you get these valleys, no matter where they are relative to where these peaks were, you are getting a peak in the S&P, and that's going to be really important here. It's not going to work all the time, and I wanted to mark that one so you know it doesn't work all the time. What tends to work the best is when we are flipping the red line right here. Let's change the color of that one. So when we're flipping that red line, and then we're pushing. Now, we can't really use this, and because I'm going to tell you right now why, because we don't have $1.7 trillion in the market. But if we go here, when we didn't in January, you can see completely very clear, and then we got overbought, and then that marked the bottom, and you can see how we ripped from there. Okay, so we understand what we're looking at. So for a bottom to be in, we want to get to this line or near this line for some type of bottom. And what's happening here is we started to rally towards this line, and now all of a sudden we're no longer there and we're starting to roll. Let's drill into this on a 1 year and really take a look at how this is going. And you'll see exactly the peak right here. And now we're starting to have that slope on the way down and what's happening to the S&P. So we're seeing smart money all of a sudden put the brakes on, and that's going to give us a point where we're not going to get that over invested and then quote low area any longer. And if we're not going to get that and they're not going to put money to work, then this current rally is going to stagnate. Let's take a look at what dumb money is doing. Now, dumb money, as they refer to it, we refer to it as retail. Of course, it's still money, but we refer to it as retail, or the smaller investor, or the person that's not trading billions of dollars in the market. And the reason for that is because we don't want to make the assumption that retail is dumb and institutions are smart, but we want to utilize this data to see what we can learn from it, and if we see any patterns. And the answer is, we do tend to see something where we peak. So in other words, we're peaking, and when we peak, the market peaks. Meaning I'm referring to myself as retail. And it's a relative. I want to be clear about that. For example, what do I mean by relative? You can see that you're making these higher highs in here. But look at these peaks. Those peaks are putting you in a position where it doesn't matter. And I think that's an important distinction. I also think it's an important distinction that it's not always going to work. So if you mark this up, we take a look at this, and I'll be clear because we're going to drill into it in a moment. It's 3 years, again, settlement trader. So, all right, so what is this telling us? Well, it's telling us a couple things. It's telling us that if we want a bottom to be put in, we're going to have to figure out what we're going to have to identify for that bottom. All right, so how are we going to identify the bottom? Well, the bottom here would be a trough valuation, okay? So you say, well, we troughed here. Yeah, well, that didn't really work because you troughed here and then you came down. All right, so is there something else that we could use? Yes, we could use the zero line. All right, so if we use that zero line and then we look, and we use that zero line and then we look, well, that's definitely giving us something that we can work off of. If we start using this and flipping it, it's giving us little indicators in here, left and right, that we have the potential to go higher. All right, so when we flipped here, what did that give us the potential to do? Go higher, and then we did. This is 3 years. So bouncing off of here, we go higher. And I just want to be really clear about this. To me, this is a little bit like a leading indicator, because as this goes higher, the market's been going higher. As this started to fall off here, what happened? We started dropping. And I'll give you a real clean example. For example, you can see right here, and what happened right up here. Well, market starts going sideways, but look how you fell down. And when you just came down that fast, then just look what happened with the market. So when you're starting to see this, even here, look at the velocity that you dropped versus how long it took to move. These are giving you clear indications. Right? You can see how steep this move is versus how long it takes to get there. That's an important distinction. And again, it's not always going to be completely accurate. And if it was, everybody would just use this and nothing else. But it does let us know that by the time dumb money or retail is getting out, you still might have more pressure on the market. And that's going to be important for this next slide. Here's why that's important. If we're taking a look at what happened here, this peak, and look at how we're starting to roll again, and we're heading towards this green line. Now we know heading towards the line, we tend to decline. I didn't mean to make a rhyme, but I did, actually twice there. So you have that line right there, and you can see where we are, and you can see where this peak is. So I want to be really clear about what I'm showing. You see where we are here, see where you are here, see where you are here, see where you are here. Okay, that's a divergence. That should not make us feel warm and fuzzy about what's going on there. That's why I wanted to drill into this 1 year. I don't want that. I don't want to have this it's still continuing down and this is going lower. That's not what we want. So what I'm proposing that if we don't see dumb money, and we're going to monitor this, we'll be monitoring it all week. And I wanted to break it out this way. And please comment on that and share this video today, because as you can see, there's a lot in here. And I really appreciate the sharing because it helps with the algorithm and the fact that I don't run ads in the middle of this. So if you don't want ads in the middle of this, just please keep sharing it and commenting, because it helps battle the algo. And there's a lot of stuff in here and there's a lot going on right now. So it is appreciated. But if you see how we're dropping here, it looks to me like we're getting back to this line. So what does that mean? It just means more pressure. It seems to me that we have more pressure right now from dumb money on the index. It also means that smart money is not peaking where it needs to be in order for us to have a bottom. And it has a ways to go to get up here and we're just not there yet on the 1 year. Now, another way to look at this is smart money, dumb money, confidence spread. And they put it together, and again, institutions, retail. And what they do is they just put smart money divided by dumb money, and this is the 3 year. And I just want to point this out because this will really hammer it home. If we look here, let's clean that off for a second. If we look here and we see these levels, we can see that these peaks, and then when these peaks have a drop, that leads to a bottom. Peak and then a drop leads to a bottom. And I think that's a very important note. It doesn't always work, right? And we know why this didn't work, but I'm not going to say it for the 1,000th time. So you can see this and see how we're doing. And so you can see that when you're at the bottom here, well, once you're at the bottom and you get this huge differentiation, and this one was enormous, you're put in tops. And now, once you're under here, there's something that we should talk about. This top right here was put in right after we had this and undercut this line of extreme optimism. So that's the way to look at it. This is pessimism, and then this is optimism. Now, for why am I explaining it? So that you understand this part of it. When you go here and you look at where we were, and then you saw how we are here, and you see how optimistic everybody was here versus what they're saying and how we're acting, well, this is an extreme reading, and now you're starting to push up. Now, look at the differentiation between how this happened here and how it's happening here right now. Now, we know why this happened and we know why it's different, but this makes a lot more sense to me. So what do we do with this? Why is this important? Well, we want this to go over the line and then come back down. Now, instead of going over the line like we did here a year ago and then coming back down, what we're doing is the exact opposite. We're over the line, we pulled back, and what are we doing? We're heading back to it. So that would lead me to believe that we have more pain coming. And that's why I wanted to explain it. And this breaks it out pretty clearly. How much more pain? We're going to go look at a couple other indicators and oscillators that are going to kind of clarify it. I really think you have to look at this on the short term and long term on where we're at. I think that's the best way to do it. But this lets us know where the players are. And if we monitor this, and if you're interested, just comment below and I'll monitor it all week. As you know, these Saturday videos, they just roll into the week so we can actually see if our thesis is playing out and then how to utilize this kind of information to make money. Now let's deal with some facts. If semiconductors don't rally, which we have a declining 55, it is impossible to have any long-term rally on the NASDAQ. It's just a fact, just the way that it is. You can go back through history, you can back test what I just said. You have a declining 55 here. You're sitting on a key level, and it looks to me like we're going to break. Now, we're going to talk about sentiment and how you yourself can look at sentiment and then make decisions upon what you're going to do with that sentiment. And it's bullish and bearish sentiment. I'm going to give a real quick lesson on it. I probably should really do a whole video on how to utilize it, but I can't see how you're not getting the 440. Let's put the 200 in. You're hanging on here by a thread. And for me, I think that if you look at what's going on out there, it's already cracked. It just hasn't actually physically cracked yet. Now, I know I say don't predict. I'm not suggesting predict. What I'm suggesting is looking at sentiment, looking at what's happening, and trying to figure out what the heck's going to hold us up. For example, Taiwan Semi, great quarter. Let's take a look at this. Great quarter. Okay, so you were a little light here, but they were talking about bookings. Things were great. Extremely positive at major investment banks coming out, reiterating their position on it, talking about multi-year EPS expansion. Look at what the stock did. I mean, that does not look like something that had multi-year expansion, does it? It looks like something that's having a really bad day. We had 55 that we broke. Then we got above. Now we're below the 200. Nothing about this is good. Nothing. All these wicks up here. What's that mean? That means that we are rejecting. The buyers are rejecting this price. We're at a lower low after good earnings. Okay, so now you have good news, and this is how you have to look at it. You have good news, and that good news should be positive, and we should be going up on that, but we're not. We're not going up on that good news. What we're doing is we're dropping. Okay, and what that means is that you have bearish sentiment, and that usually means that if you have good news and stocks drop, you have bearish sentiment, and that usually means that this is what's going to happen. You're going to have a drop. That's a really important distinction. I'm going to give you another example of this, and I watch this more than anything. I learned this a long time ago, and it works. It works extremely well. When you had good news here, this was something that we had a position on at 180, and we did exceptionally well with it. At one point, we were up $12 on it, $11, $12. And you get 2 upgrades in a day. And everybody needs to be in this. Everybody's getting very excited to get into crowd. And you can see that right here. All right, everyone know I got to get in. They're going to buy it. We're going to 215. We're some of the targets. Things look great. Everybody's warm and fuzzy. And then what happens? You completely reverse and you get this bar here, which is called the Marbuzu Black, which is pretty much about as negative as you can get at the top of a chart, right? All right, so you get that. And then the next day, what do? You break down. Okay, so this is another example of I've got really good news, and then after my really good news, the stock goes down, and that means that I have bearish sentiment. That alone is worth watching this video for. That alone will save you an inordinate amount of money in trading. If you get upgrades and you're buying those and you're down on the day, you're on the wrong side of that trade. Period. And you might want to pay attention to that again, because we're seeing this everywhere. ASML, which in my opinion had a really good quarter. I thought the quarter was great. I understand you were off, but we knew that this was coming because Taiwan Semi said they're delaying everything. They talked about bookings going out, multi-year expansion into 24. Okay, that's great. What do I have going on here? I have a death cross sitting up here. What happened to the news after earnings? All I did was go down. There was no change in sentiment here on good news, and this is still the prevailing trend. We couldn't even get up here and test it. When you see this kind of stuff, we have to pay attention to it. Now, bad news is bad news, and that needs to be respected. But when you see bad news, stocks going up, you want to pay attention. And the best example I have of this is the S&P and what we saw here. Now, what we had here was a really, really bad report, but people dug into that number and went through it line by line. Institutions, remember, you're playing against the smartest people in the world. But what that helps you remind you of, if you're playing against the smartest, most disciplined people in the world, and trading is asymmetrical returns, meaning 85%, of traders that consider themselves profitable are a little bit profitable, but the real returns are made by maybe 4 or 5% of the people that are playing the game. Now, if you look at this and you say, okay, well, why did we go up right here? We went up because someone went through those numbers and realized we were at peak inflation. And we're all watching this chart break, and we're all looking at my stool and saying, well, technically, we're going to break here because we took out the lower low. It's the macro that made the difference. And understanding that gave somebody an edge, and they were able to pick up the bottom. In this situation, you had bad news. Leave these on for a second. You had bad news, and then what you had is you had the stock go up, and this led to bullish sentiment. And that changed everything. And what you have to understand about sentiment is the fact that it's not like it just flips back over. It stays. And that's why it's so important to note it. It's not like it just takes a day. No, this flipped, just like we're seeing with crowd. Now, if we think like this and we look at this, what does that mean? It means that we have to take into account and really look at what's happening here. And as we go into this week and look at some things, yeah, Tesla was a dumpster fire, and we all know that, and the stock broke 200. And what is really so fascinating to me is the amount of people that are out there defending the quarter. I find it fascinating in my comments, and people are welcome to. I mean, I have my opinion on it. Today they have a video on social media where he's showing that it's bulletproof. You know what every soccer mom wants? A bulletproof car. Okay, so I don't know who he's marketing to. Maybe five people in the world, or 5 people in the US want a bulletproof car until the zombie apocalypse happens. So until then, instead of that, people are going to want something that they can drive. I think this opens up Rivian, and I know Rivian looks absolutely god-awful here technically, but I think it opens a huge market for them. It's just my opinion, and they're the ones that are beating deliveries, not Tesla, just FYI. But before I go into one of my famous segues, I think that what you have to look at here is say, okay, well, this makes sense because this was a dumpster fire, and I don't care how you slice it. Take a screenshot of that, that's what a dumpster fire looks like. Right, so that makes sense, and why that's dropping. Well, why is Google dropping? Why can't Google hold its footing? We still have AI. We still have everything going on. Everything still looks great. We're still above the 55. Why can't Google hold here? And I think that they're the things that we have to start looking at and going, okay, well, Google's going into earnings on Tuesday. Microsoft. Why can't Microsoft hold here? Why didn't Microsoft hit the 55 after being above it? Why did we reverse and have this sell-off? Well, earnings are coming out when? Tuesday. So why are they getting out of these names before earnings? And I think that this is what you have to wrap your head around a little bit and say, okay, are we seeing some kind of massive shift? If you haven't figured out this from this video, I'm suggesting that we're seeing a massive shift. If you haven't figured out what I'm trying to put down. And this is troubling to me, one, because I don't really want, I don't want to see it, but the market really doesn't care what I want, right? It doesn't really care that it affects my ego, because I was hoping that we would rally. So the market could really care less how I feel. But if we take a look at something like this, left shoulder, wow, head, right shoulder, neckline. I can say anything I want about this company. I think they're going to be bigger than Apple, and you can cut this out and timestamp it. I do. That doesn't mean it's going up next week. Yeah, I have to trade the fact that I now have a declining 55. I have to respect that. I have to respect that if I break that neckline, the way that I view the world here is real simple. I have to measure that move from here, okay? And that gives me a 19% down percentage. So I'd have to go here and go 19%. Where's that put me? Puts me right around here, 18, 19%. So I have to understand that one, I have the chance of that gap fill, and two, I have the chance of the full gap fill. That is a possibility now. And then of course you also have here, I have no idea how earnings are going to be perceived. I don't have a clue how these earnings are going to be perceived. But I do know what we're starting to see here is we're starting to see a massive shift, and we have to pay attention to that shift and figure out how we're going to profit from it. That's it.